Good evening and welcome to tonight's live webinar where we look at ASX investment opportunities in review for the 26th of July. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Investor Signals provides a broking account service. If you'd like to know more about it, please contact me on 1300 614 002. The service includes access to our model portfolios, which will be the topic of tonight's review. The technology we're using is the Investor Signals member area. If you're joining us for the first time as part of your 30-day free trial, just a reminder, don't hesitate to contact me in the office, and happy to provide you some tuition on how to navigate around the member area and, importantly, how to set up the model portfolio alerts. Moving straight into a graph of the US market, up on screens the S&P 500. We're approaching now, well, we've started the third week of earnings in the US. We have Apple reporting, Tesla. We start to see some of the bigger payment companies. We see MasterCard, Visa. We start to see Alphabet. So some of the big names coming through over the next sort of 7 days in the US. The numbers up on screen here represent the average earnings for the S&P 500, and we've looked at this in a table format, but to have a look at it as a reference point on the graph. So 2018, 2019, average S&P earnings were $165. The index was around 3,000 points. If we apply roughly $10 increments as an increase to the average earnings, we get to where we are at the moment, which is the market having to deliver roughly just under $50 of earnings on average per quarter. Now, the March quarter was just below that. It was running at around $45 of earnings. When we get through the completion of the June quarter, we would need to see that number up around similar, around $45 or $48, or maybe even nearing $50 of earnings to support the valuation where the market is at the moment. If we have a look at just the short-term momentum, we had this pattern that's becoming quite familiar, where we get a couple of days below the average and then the buy on the dip occurs, and we're seeing positive momentum there. So as we move through the top 100 companies tonight and have a look at the stocks that are in the model, we'll identify the names that we see value at the moment, and we're focusing the buying interest around. So coming over to the watch list, moving down, selecting ASX 100, get the percentage gains to the top, organise these in buy signals. I'll be looking at the stocks that are under algorithm buy signals, therefore you'll find them in the model portfolio under ASX 100. These are all the stocks that are under buy conditions. We'll get part the way through the list. The stocks will move from buy into sell. I'll highlight those that are under sell conditions and identify the one or two names within those group that are under sell signals that we're interested in from a counter trend standpoint. Linus is in the model portfolio under algorithm buy signals, performing strong at the moment, and you can see there that support at $5 is held and the stock's rallied. Illumina following a slightly well, the concern with Illumina's earnings were higher operating costs, but as I suggested last week, the expectation was for the market to sort of rebound from that. So from that 150 level, now trading 170. Oz Minerals, now this is a stock that we are allocating to, so if you don't hold this in portfolios and you're looking for added resource exposure, Oz Minerals on this pullback from 27 back to $20 is a buying opportunity, and we've added that into model portfolios. Harvey Norman under algorithm buy signal, but understandably at the moment you may be a little bit cautious on Harvey Norman's. Altium Group, not doing there. They've rejected the takeover bid from Autodesk. South 32, we like South 32, and in general the resources still remain sort of a shining light within the market. So whether you want to think about OZR as the resource ETF or the individual stocks, but if from an individual standpoint we like Oz Minerals. BlueScope's also under buy conditions, strong earnings momentum, we like that. BHP remains a core part of the model portfolio and we're overweight BHP. Incitec pivot, better second half earnings report anticipated, and the stocks rallied from sort of that 225, 230 level, now pushing 260, and maybe there's a little bit more upside in Incitec, but we won't get another detailed trading update from them for another 4 or 5 months, but I think the market expectation is for Incitec to move higher. Lendlease, a difficult operating environment for them at the moment, but the stock is cheap and a lot of bad news priced in there. Cochlear, we continue to like this, recognise that it is a little expensive, but delivering in excess of 20% earnings growth. It's performed very well since being added into the model portfolio. Macquarie remains our preferred financial services play. Some of the banks we've started taking small positions in. Also have a think about the BNKS or BNKS Global Banks ETF. The equivalent here in Australia is the MVB, which is a diverse portfolio of the Australian banks. But Macquarie's the quality allocation within that sector at the moment under algorithm buy signals. Metcash doing well, is a little expensive, prefer Woolworths over Metcash. Fortescue iron ore's pulled back from 220 back to 200. What we're likely to see is great earnings results from the resource companies, in particular the iron ore companies, strong dividends, but there's an anticipation that iron ore is going to continue to retrace, especially as we see Vale come back online, or at least anticipation of that. I think in the end, iron ore prices settle somewhere between maybe 170 and 200 on the upside, which really won't stop. Won't really hurt the share price of Fortescue, BHP, Rio. A lot of the analyst models have much lower spot iron ore prices in their forward forecast, maybe closer to $160. So if iron ore over the next 6 or 12 months can stay within that 170 to 200, I don't think the downside risks are substantial to the iron ore names. Aurora, we like this high quality business. Company buying back shares is expensive where it is at the moment. Just wait 2 or 3 months for a pullback in the share price there and think about that on the next algorithm buy signal. Wesfarmers, this is overweight position in portfolios. It switched from sell conditions into buy at around $43, now pushing 62. It'll be interesting to review the upcoming earnings result there. Xero, we like. The high quality technology stock is a little expensive. ResMed, we've started taking profit, but it is in the model portfolio at the moment, but in individual accounts we started taking profit there on ResMed. JB Hi-Fi under buy conditions, but again a little bit cautious right at the moment on some of these retail names. Cube, I think you could have a think about this. It's corrected from 325 back down to 290, 294, representing some value there. Sydney Airports rejected the takeover bid. The market's speculating that there will be a higher bid coming forth for Sydney Airports. Charter Hall, within that whole property space at the moment, Goodman Group's the preferred allocation, and the SLF, rather than having too many of those property property REITs in your portfolio. The banking sector, just highlighting that you've got CBA under buy signals. You've now got ANZ and Westpac under buy. You've got the global banks ETF under buy signals, but Macquarie remains our preferred exposure within that space. Goodman Group, high quality REIT, above average earnings growth, but is getting expensive. If you don't own it, just now wait for a pullback in the share price and the next algorithm buy signal over the coming months. REA Group, expensive at 60 times earnings, so we're not doing too much there, but just highlighting that it is in the model. ANZ now under buy conditions, so we'll sort of see whether that support holds around $26. WiseTech under buy conditions, it's in the model portfolio. Computershare, this correction from around $17.50 back to $15.50, now trading $16. I think Computershare and Link, two names you can think about adding into your portfolio. Aristocrat Leisure, a little expensive. I'd wait for that to pull back and an algorithm buy signal before you add that in. Seek, little expensive up here where it is at the moment. Again, if we see it at lower levels, happy to take a look at that. Westpac under buy conditions at the moment. Our allocation initially to ANZ and Westpac is extremely small, and we're going to average into those positions over a period of time. The only full allocation that we have within that financial services is to Macquarie at present. Soul Pattinson under buy conditions performed well. Woolworths obviously benefiting from people being at home, and Woolworths and Coles generally, when we look back at the response during the pandemic, Woolworths and Coles have done well under lockdown conditions. Woolworths up here at $39 could be starting to get a little bit expensive, though. To put that in context of where it used to trade, it puts Woolworths on about $45, really at the lower end of that 2% dividend yield range, so maybe getting a little expensive up here at around this $39-40. Interesting to have a look at the upcoming earnings result. Tabcorp under buy conditions, we've got the demerger there that's to take place. Link at around $4.80. I think something you could start having to think about building a very small allocation to. Stockland under buy conditions at $4.30. You can see the range there that I've created on Stocklands. ALS under buy conditions continuing to trend higher. Domino's under buy is a little expensive where it is at the moment. Be patient, wait for a pullback and the next buy condition. Challenger under buy conditions, but again prefer Macquarie over Challenger. Treasury Wines, looks like we've got sort of a turnaround into a pattern of higher highs and higher lows here for Treasury Wines. So we've had the breakout from the downtrend there to around just under $12. We had the pullback to $10, starting to grind a little bit higher after consolidating sort of around just below that $12 level. But Treasury sits in the model portfolio, as does Oil Search, and obviously you've seen in the media that Santos has making a takeover bid for Oil Search. Cleanaway under buy conditions. This is one I think you can add to your watch list and keep a close eye on. Around this $2.50 level should be support. What we're looking for is really some price action back above this moving average, but purely from a valuation standpoint, around that $2.50 starting to look attractive. Woodside Petroleum, within the energy space, it's still our preferred exposure. Northern Star, I thought the earnings result looked alright here. The cost savings from or the synergy cost savings looked attractive. Looking for this to find support at around $10 and trade high. Still our preferred gold exposure play. Evolutions concluded their capital raising. Downer EDI, preference CIMIC, and I'll have a look at CIMIC at the end of the recording, but Downer in the model, as is Santos. Beach Energy in the model, again preference Woodside over all of the others. Afterpay, it just trades on a high PE with a lot of blue sky priced into it, is under algorithm buy signals and has performed well, but not a stock that we're adding into our private client accounts. IDP Education under buy conditions, but again a little bit expensive. GPT withdrew their guidance given obviously the impact that we're seeing at the moment from lockdowns. SLF's a lower risk way of playing exposure to the REITs. Goodman Group's the preference, but too expensive where it is at the moment. So if you're not holding any of these, maybe just sit on the sideline. A decent retracement in Goodman Group might give you an opportunity to add that into portfolios. Star Entertainment and Crown under pressure at the moment. Centre Group, as you'd expect, also under pressure. Crown, just be patient here. Wait, keep this on your watch list. Wait for a trade above that 10-day average as an entry opportunity. Rio preference BHP, Oz Minerals and Fortescue over Rio, but I think we see Rio's upcoming earnings results as one of the first of the majors reporting. Insurance Australia Group, this is a counter trend trade, so we've now shifted into stocks that are under sell signal, and rarely would I have a support line under something that's making lower lows and lower highs and under algorithm sell signals. But Insurance Australia Group, I tend to feel from a fundamental analysis standpoint that they're near to an inflection point in their earnings. We've seen them upgrade their insurance margins but to around 13 to 14%, but still the expectation is that they only deliver single digit, so 5-6% earnings growth over the next 12 months, but that may be a little bit conservative. But on a 4.5% dividend yield, the stock looks attractive. If they do deliver earnings growth even into that single digit level, we can see the stock re-rate up to this $5.50 to $6 range. So I've shuffled the support in there at $4.70. Happy to be long the stock with a stop loss below that. Mineral resources, avoid that at the moment. Wait for a more material pullback. We'll see a buy signal in mineral resources later this year. Reliance up against resistance. Be patient there. Nine Entertainment not doing there on that one, nor in QBE. Reese, again, be patient. Wait for a more material pullback and a shift to buy conditions. Qantas, we're not doing there at the moment. Ansell up against resistance around that $40 level, $41. ASX, a number of analysts actually upgraded the price target on ASX to as high as $90 in some cases. It is under algorithm sell signal. We'll have a look at the upcoming earnings. I'd be surprised if there's too much in the way of revenue growth, and I'm thinking that the earnings is probably only something in the order of 2 to 5% earnings growth, which hardly would support a push up to $90, but we'll continue to review that as the earnings results come through. Car sales, be patient here. I suspect it's getting close to running into resistance. What we're looking for is a pullback in the share price and a switch from the sell signal up the top to an algorithm buy signal, which will be the green box at the bottom. So maybe a pullback to around $20, and we'll see that shift to buy conditions. Next DC under sell, not doing there, cautious on next DC. Coles, preference Woolworths over Coles. Again, we'll wait for Coles to shift back to buy signals. APA under sell signals, so we're not doing there. It's not in the model at the moment. Boral, Seven's moving in on that takeover deal. Medibank Private under sell signal there, resistance at 340. Sonic under resistance at around $40. I think that's too expensive now. Suncorp, IAG's the preference over Suncorp. Bendigo not doing in the regionals. If you want to have a look at the banks, think about BNKS's exposure to the global banks. Otherwise, Macquarie remains the preference locally. Amcor, just to back that up there and stop on Amcor. At around $15.50, the stock's fair value, just under a 4% dividend yield. The company guiding towards 12 to 14% earnings growth. I suspect this actually breaks higher, so we're happy to continue to hold Amcor. Bank of Queensland, cautious there with overhead resistance. Brambles, overhead resistance at around $11.50, $12. CSL, undersell signals, has broken into a new high. The next algorithm buy signal, we want to look at adding that back into portfolios. Transurban, difficult to get visibility on earnings at the moment, just highlighting that it is under sell signal. NAB's under sell signal. Fisher Paykel under sell, which I think Fisher Paykel's a little expensive, so I wouldn't be surprised to see that pull back. James Hardie under sell signal, resistance at around $46 there. Telstra, one of the few stocks that we're holding, so even though it's under sell signals, we've been sticking with the long side there of Telstra. AZJ, waiting to see whether this can break out of what's been a 2 to 3 year, maybe not quite that, so about 18 months that the stock's been in a fairly prolonged downtrend with the rallies and the sell signals on the peaks there. But what we're starting to see at the moment is maybe a bit of a consolidation around this 3 to 390 level and looking for it to break out. The first bullish sign will be a break above $4 there for AZJ. Magellan under sell signals, overhead resistance at around $55. Origin, still looking for evidence that that's going to break higher, but it's maybe one you could think about buying calls in. AMP, cautious there. Ramsay, buying that just as an income contributor to portfolios. AGL, waiting for more detail around the separation there. Newcrest, preference Northern Star over Newcrest. Ampol, so the old Caltex business, under resistance there. Worley's under resistance, not doing there. Orica continuing to make lower lows, lower highs. A2 Milk, overhead resistance there and a sell signal at around 750. Really would like to see this trade back through that 750 level to suggest that the downtrend has ended. Having a look at a couple of the ETFs that we like at the moment. So Cure continue to be a buyer of this on the sell-off. It's corrected from 85 down to 59, so we're buying that. The OZR, which is the resource ETF, at the moment our preference is to actually own BHP, Fortescue and Oz Minerals, a little bit of South 32 as our resource basket. But the other alternative here is to have a look at this resource fund. But my preference is to be a little bit more selective and own the individual stocks or the preferred stocks at the moment. In addition to those other names within the resource space, obviously we've got Incitec Pivot that I like and believe in that second half recovery story there. CIMIC delivered their earnings update. The market was pleased to see them continuing to pay down the factoring debt. Guidance looks okay. Work in hand has increased, I think, around $30 billion. The stock rallied from $19 up to $21. In some cases we own the stock with this one, but also in other positions we've bought the call options out to December, the $20 call options. It's just another way of capturing upside exposure without taking on the full downside risk there. In the news we're seeing obviously some negativity around the implications of the Chinese government imposing regulatory reviews across their tech sector, which is weighing on the share price. And if we look at the performance of this, we had the algorithm sell signal there at around $62. We did trim our exposure, but we didn't cut it completely. We are sticking with some long exposure in both the IZZ and the Asia ETF, which is the tech ETF. So we, as I mentioned, we did cut the size of these positions, but we didn't get rid of it completely. But at the moment, the algorithm signals proving that was doing a good job of flagging those highs. But on fundamental basis, we're sticking with these. We think there's value there in these tech sector companies, even under an environment where regulatory reviews taking place. On the if we see these earnings this week in the US obviously disappoint, or we were to see the Nasdaq or the S&P come back below that 10-day moving average, and you can start to have a think about these inverse ETFs. But with the index above the average at the moment, it's not something that I think too much energy needs to go into. But if we see a change of those conditions, and just jumping back to where we started this evening's webinar, and that was a look at the S&P 500, whether it's the S&P or the Nasdaq, the pattern's similar, which is where we've had the break below that average and then it's rallied straight back above. So it's not unless we saw that roll over and back below that average, and I'll draw your attention to that via the blog. Thank you for listening in to tonight, and I look forward to speaking again next week.